Hey, good morning, guys. So, look, I've done a couple of videos in, well, the last 2 weeks really on this mechanical structure, right? The title itself is definitely not clickbait, right? I wanted to put something there because I know some people will be like, oh, well, I want to do this and I want to do that. I want to trade, my $100 account into $1 million overnight. You got to understand these types of things are not possible, right? You got to understand that if bots worked all of the time, the people building them, they wouldn't be selling them. They'd be borrowing 25 million from JP Morgan. They'd be trading it up to $1 billion themselves and selling it back to someone like JP Morgan for billions and billions, right? If you want to make some real money and you want to trade more professionally, you're not looking at this as a hobby. You're looking at something that can actually bring you an income. These techniques, right, they take a little bit of getting used to, but because of the mechanical nature of the techniques, they're very simplistic to deploy, right? You can then add layers almost on top to refine it and refine it and refine it. But the general idea is that by having a statistical edge, you'll be moving forward with time, right? So this is where you start to make, more and more money. You get more and more confidence in your setups. They're more and more mechanical in terms of, if this, then that. Then ultimately, you just keep moving forward, right? So what I want to do is just on the back of all of the ones that I've created from the mechanical kind of structure, mechanical trading videos, I want to just kind of put it all together, right? So I've come up with this as a particular image, and again, nothing's textbook, right? So just kind of take this as an example. Right? So what I want to do is to break into the logic, right? And then what I'll do is I'll cover things like the Dow theory, the Elliott, and the Wyckoff, and kind of how this wraps around, right? And I'm hoping by the end of the video, things will start to kind of piece together for you. Now, look, if you think of a move like this, the longs and shorts is, right, we must have come from a move like this in the first place, or ultimately a move up, right? So let's assume that we're going to look at this almost as a reaccumulation type move. Well, first things first, we can say, well, the price has gone, you know, down, up, right? Now, if I was to take this as, let's assume a daily range, my yellow lines are actually the daily range. If I think of what's happened, the previous low, which was down here, right, was actually broken, which means we had a move that looked like this, pulled back, failed to make a new low, and then pushed up, right? So this line here, I'm going to talk about it as my gray line there, right? So that's the first, bit of context for you. Now, what happens from there, right? From there, the price rallies and we get to this first particular point. Right? Now, this creates the baseline for the top of the move. This is where people are seeing the top on a daily range, right, from the last swing. In Wyckoff terms, this aggressive move away, we class this as an AR. Right? This is an automatic reaction. Right? This reaction is ultimately the bigger players selling off based on their earlier buys down below. So what you then have is, let's say Bitcoin, great example. In 2021, we had Muppets like Plan B saying, hey, we're off to 135K. And we dropped down to 15. Now, the reality is, part of the point and part of why these kind of moves happen is that you still have buyers, right? And, this tends to be the retail crowd. Retail tend to get in almost at the wrong time every time. So we've got a lot of buyers buying the top, and they're actually holding a lot of this, right? Not always, right? They'd be out of this, sometimes around this level. So let's just assume that they're not, right? What then happens is you have another reaction away from the trend. Right? Now the issue is, from down here, what this looks like at the moment is we are seeing this, right? And then what happens is we start to see a push down. Well, this push down here is where a lot of people who didn't sell there, they start to question their life choices here, right? So logically speaking, if we look at what happens then from there, the traders who sold at the swing low, as well as the traders who were buying up here, they start to think, right? They start to kind of wake up. They start to think, oh my God, I'm in the wrong position. I'm in the wrong side. Is this going down? Was this now the high? Are we seeing a new downtrend form, right? And it becomes, it becomes emotional, right? For a lot of people, this is very emotional. If you don't understand what you're looking at, in these kind of fractal moves, in these larger time frame moves, and especially when you're looking at a smaller time frame only, right? This is going to be very, very difficult. But this happens on every time frame, right? You can see this, all day, every day. Then ultimately we get to this low, right? Now, what's happened bigger picture is, in theory, we failed to take out this low. So the main point is we've almost kind of set a little bit of a precedent in terms of, why and where we go. Now, if we were to rally up and fail here, right, the question mark could still be, are we in distribution phase? Right? And this is where Wyckoff comes in. This is where utilizing Elliott to understand where potentially you are in the cycle comes in, right? And I'll touch on that a little bit in a second. Now, all of a sudden, we rally up and we make a new high, right? But we kind of fail to sustain the high. So at this particular point, right, we've got buyers buying the breakout, right? This is obviously attracting more momentum. It's also triggering stop losses of people who sold up here. So at this particular point, we then come back down, and everybody at this stage is pretty much confused, right? It's, what the hell is this? What's going on, right? Now, there's a couple of signs, things like a master pattern, right? And this will help. Again, it's another technique to do with Wyckoff, but the longs and shorts of that is there's another technique around that just makes it easier and more obvious to see, to understand, what we're likely to see next, right? Then from the high, we create this next move down, this next low. This was the profit taking from the first move. Now, this could be profit taking from here, from here, from here, right? Because the larger players already know the outcome. They're already working towards that, reaccumulation type move up to the right. Okay. It's only retail that are looking at this small time frame that don't really understand what's going on and why, right? So we then create this profit taking phase. Then we come up to create a second high, which basically acts like a sweep, right? So if you drop down a time frame, if we went down to say a 4 hour or a 1 hour time frame from our daily being these yellow ranges, right, you're very likely to see a sweep move, which also brings a very aggressive move down. Now, what you have to understand is the reason for this aggressive move down is, again, this kind of profit taking, right? This confirmation of the uptrend. And this is where the big players can say, okay, I want my fair share underneath the center of that master pattern, right? This is where the buying at a discount comes in, okay? And at this particular stage, retail traders on a smaller time frame, what these guys are actually seeing, and this is where a lot of people get this wrong, over and over and over again, is we've seen this move up here, and then we've come down. As far as they're concerned, we've changed the character, right? We've come down. Whereas overall, all we've done on the bigger time frame is we've gone from here to here on the big time frame with a pullback. It's this internal structure, this smaller time frame move, that's actually done the confusing of the masses, right? So once we've grabbed liquidity, we get the final sweep. And that final sweep is to get rid of anybody that's bought in too early, to give Composite Man the last chance of buying at a discount. Negative news tends to come into the market, and the price darts up, right? So to grasp all of this, and the reason that I'm saying, this is why this is an easy path, easy route, right? I'm going to hide this at the moment. Let me see if I can hide that image. One of the things that I've posted a couple of times over the last couple of weeks, and even the last couple of years, I've posted this several times on TradingView, is the Dow theory, right? Now, personally, the Dow theory for me is almost like the granddaddy of all technical analysis, right? Wyckoff, Elliott, everything else, master patterns, smart money concepts, and all this kind of other shit that's out there. It all fits under this as a whole. Right? So, what Dow theory basically suggests is the market has three movements. Movement number one is basically this, right? You have an accumulation at the bottom. You have the markup phase and you have the distribution, right? I'll talk about this next in my next image, a bit more in depth, right? So you have this, but inside of this, you also have three trend phases. So as I just mentioned, right, if we were to talk about this particular red line from here to here being a daily, inside of that move, we're very likely to have, say, a 4-hour type move, right, that does something like this. That 4-hour move also has internal fractal structures, right, that look like this. So I'll make that a different color just to emphasize it, right? So basically you have these three trending phases, right? Now, again, this is something that is pretty obvious from an Elliott perspective, right? You'll see that these moves are actually classed as what they call nested from an Elliott point of view, right? The third point in terms of the Dow theory is the stock market discounts all news. So the price is already baked in essence. Now, a little bit further away from whether you're trading Forex, Bitcoin, oil, gold, this one, it's, when the theory was kind of created or the theory was kind of written about in the first instance, indices was ultimately what Dow is known for. You've probably heard of the Dow Jones. When all of these indices kind of come together, right, it kind of, I guess, kind of gives you the momentum in the direction, right? So if all indices are kind of falling down, the chances are the global stock market is on the downtrend, right? Now, I know that sounds pretty obvious, and it kind of is, but the point being is once you understand, where this is coming from, this for me is more of how I would say the trend is your friend, right? This is the kind of the rationale behind it, right? Is that if all of these things are kind of coming together, if gold is going up and stocks are going up, right? The truth of the matter is there's kind of positive momentum kind of in that market. The next one is trends are confirmed by volume, right? Now, this is where Wyckoff comes in, right? If you're looking at Wyckoff and you're not looking at volume, right, you're not really doing Wyckoff, right? There's a lot of little tricks and hints and things kind of around the volume. There's a lot of things inside the candles themselves, right? And these are the kinds of things that obviously we teach, right? This is kind of the depth in terms of going inside of why these moves are playing out the way that they're playing out, right? But again, volume tells a pretty compelling story. It gives you a lot of insight in terms of why, what, where, and I'll touch on that again in a couple of seconds, right? And then the last thing is the trend is kind of the trend until the end, right? Now, one of the things with the first image that I shared is when the market finishes, you tend to have an aggressive drop down, you tend to have a pullback, then you have the breaker structure. Right? Now, the breaker structure, which in essence is this move here, right? So, technically there, is not only the break of the structure, is that the trend was up, right? So now we have this market structure shift to the downside, right? This breaks the structure here, right? So all of these things kind of cross at this particular point. And this is basically saying, the trend is the trend kind of until the end, right? So this would obviously be the daily pattern, for example. Now, inside of that move, obviously we're going to get, a 4-hour move like this. You're going to get, a 1 hour or a 15-minute move internally, right? Nested. So you can start to see how these things come together, right? Now, let me get rid of all of these drawings a second. Let me get rid of that. Let me just make sure I don't tag the image. Here we go. So, next one. If you can put all of those pieces together, we have, as I said, the accumulation at the bottom. We could see as a master pattern Wyckoff. We then come up and we create this kind of aggressive move, which in essence will leave things like an imbalance. Right? So leave a fair value gap. Then we come up and we start to distribute. As we distribute, we get an ABC on the nested move. We start to get a range bound move on a smaller time frame. And then we actually know that we're accumulating again because the momentum is to the upside. We change the character as we break through this particular level, creating an impulsive move with breakout buyers, new orders coming in, short stop losses being triggered, etc., etc., etc. Right? Now, at this particular stage, we get to another distribution. This really is the kind of the bigger reaccumulation, right? This reaccumulation happens, and this is why the move 3 to 4 on an Elliott tends to be more kind of sideways for a while, just to kind of confuse everybody, thinking, well, the momentum's kind of gone, we haven't really dropped, could we go up, could we go down? And that's the kind of message the composite man wants to kind of keep retail traders thinking in, right? That's the kind of the area that the mindset will be, I don't know what to do next, right? Then we ultimately come up for a 5. We get a 5 distribution. This is a much bigger distribution. We then have an A, which tends to come back to something like this fair value gap. We then have a B, which tends to come back to this fair value gap. And then ultimately we drop down, potentially back down to these kinds of regions, right? Which is why you get 100%. You get a pullback of 68%, right? Or the 68. And then you basically have a 1618 or a 127 to a 168 in terms of the extension. And that's, kind of the story as old as time, right? So when you start putting these pieces together, it's pretty obvious why the market does what the market's doing. It's only ever chasing liquidity, right? So what I just touched on in terms of Elliott, this is the general concept. You get your nested moves inside. You get your larger move, which is the one in brackets. You get your ABC pullback. You get your larger 2, right? The 2 then gives you your nested 1, 2, 3, 4, 5 internally. You get your move ABC, right? And there can be a lot more complications when trading purely Elliott, right? You could end up with a zigzag. You could end up with, an expanded flat or a running flat. You could end up with even things like a double, triple type move, right? That just makes the whole thing a little bit more confusing, right? And there's one quote that I absolutely love. I don't remember who said it, but it was something along the lines of, if you ask 10 Elliotticians for their current count, you're going to get 11 different answers, right? And that couldn't be more true. The general idea of utilizing Elliott for something like this is just to get the overall sentiment, right? If this momentum looks up, then we've got some kind of estimation for a turnaround, which we can then start looking for a Wyckoff structure to the downside, right? And that's simple as. For the sake of keeping this video as short as I can, right, I'm going to put these two kind of almost together, just to kind of emphasize and highlight, right? Now, obviously, I've just touched on the 5 from an Elliott perspective, which means we'd be coming into a distribution, right? There's obviously coming into your 5. At this particular point, what tends to happen is similar to the first image. We get a climax. We get an automatic reaction. The automatic reaction confuses everybody by going back up. We then create, right, our kind of telltale sign. This is why this first move is kind of important, right? Because it kind of gives the hint in terms of where we go next. And again, these are things we teach, in depth, right? Then we ultimately get this move up. This move up is the UT. Then we come back down, and at this particular point, we are in that confusion state. We have a 50% marker. This is the master pattern, right? We can start to work on what we're likely to see next and why, right? We then get the expansion phase, the expansion back to the 50%. Then we come back in, and we don't always have to touch that 50%, right? Because at this stage, we've got an awful lot of, this is actually acting as support, now becoming resistance from the downside. And then we get that markdown phase back to ultimately the Dow theory concept of only having 3 phases. We had the accumulation at the 0, right, which was obviously down. Oh, I'm going to change that from white to red, right? We have the accumulation phase obviously down, down low. We then ultimately had the markup, which is here, the markup, right? There's the markup. And then we have the distribution, which followed by the markdown, right? So at this particular point, all of these things kind of coming together, right? We can talk about obviously how the volume increases, right? And this is the kind of momentum candle that you're looking for on the breakout, right? The same thing to the downside. You'll start to see the volume, you start to see the volume increasing, right? And as that volume increases, we start to get that move down. You'd expect then, if this was from the high, you'd expect this being the 100%. You'd expect a 618 pullback to the downside of that trend, and then you'd expect, ultimately the 1618, right, or along them. Now, again, this is just kind of, no textbook, just ultimately the general concept, right? So when you start putting these pieces together, although this is less of the mechanical structure overall, this is how the mechanical structure fits into all of the bigger market structure as a whole. Okay, so I hope you enjoyed this one. I wanted to keep this one as short as I could, and obviously I'll be doing a few more like this, back to the kind of mechanical chasing euro in the next couple of days. And I'll do then another update on the Bitcoin side, which is what I covered with follow the money being the last video on that. All right. Anyway, have a great week, and I'll see you on the next stream. Thanks for watching, guys.